Hello everyone, it's Ted Bauman here with your Friday Bauman Letter video. Well, the markets have bounced back today after having had a really torrid time of it yesterday on inflation fears, and people are fishing around for what's going to happen next, as we're always doing. Today, however, I want to talk about something that you should not be doing, and that is investing in companies like Uber, Lyft, and DoorDash, or any other company that operates what is known as a platform business in the real world economy as opposed to software. Let me explain why. First of all, the concept of a platform company is essentially that you establish a company that begins to become the standard way of doing something across an entire industry. The classic one, of course, is Amazon. It has created this shopping platform that has essentially driven everybody else out of the market except for the few who have deep enough pockets to compete, like Walmart, Walmart, Target, and a few others. Now, the idea of the flywheel is that you gradually build up a position where you are the only game in town. And so everyone is forced to use your platform to do whatever it is they want to do. In Uber or Lyft's case, that's transportation. In DoorDash's case, that is food delivery. And so therefore you begin to A, make monopoly profits, and B, begin to have other people building side businesses and other apps and other kinds of things that depend on your platform, right? That's what's happened with Facebook. That's what's happened with Google and so on. Now, one of the critical things about companies like Uber, Lyft, and DoorDash, besides the fact that they operate in the real world economy, in other words, where they actually have physical world expenses, is that these companies were able to attract dramatic amounts of venture capital starting in the early 2000s. In Uber's case, for example, it was the Saudi royal family. The Saudi royal family wanted to move away from its dependence on petrochemical income, and so it funded SoftBank, Masayoshi Son's company, which in turn funded Uber. The idea was that they could use this money to try to establish monopoly platforms in different parts of the world, the Saudi royal family, where they could replace their monopoly platform with oil. Now, the strategy is what was called Blitz Scaling. Now, Blitz Scaling involves essentially just moving into an industry and just breaking things. And in Uber's case, it meant breaking local taxi laws and, effectively just ignoring regulations. But the key thing is that they had to lose money in order to do this. The whole idea was that as long as a company like Uber or Lyft or DoorDash or some of the others could continue to attract venture capital to subsidize its operations, eventually nobody would be left standing and nobody else would be able to compete with them. Now, Uber, when it went public, had to file what's known as an S1 document. An S1 is a form that tells the stock market and everybody else in the world exactly how it plans to operate its business and how that business is going to create profits. Now, Uber's was very honest. It said that there were two basic conditions it had to meet in order to make long-term profits. One was that practically all the transport operations in urban parts of the world would have to be replaced by Uber. In other words, it had to be the platform. It had to be the Amazon of transportation, which is what it calls itself. The second thing was that eventually all of the drivers that it uses in its business would have to be replaced by robotic vehicles, autonomous vehicles. Now, there's a reason for that, and there's a reason why it was honest about that in the very beginning, because that's the only possible way that a company like Uber or Lyft, and as I'll show you, DoorDash in the food delivery business, can actually make more money on every ride or delivery that it gives as opposed to what it spends. Because right now, that's what happens. It's like giving away $1 to make 90 cents, and you keep doing that over and over again. And that's effectively what these companies have done. Now, let's talk quickly about Uber's most recent results, because I want to show you how this has played out and how they have gradually kept trying to, in a sense, mislead investors, as I believe they've been doing all along, in order to try to create the impression that they can someday be profitable. Here's a chart that shows Uber's gross bookings. That's, in other words, the number of people who actually use the service, and then its adjusted EBITDA, which is earnings before interest, taxes, depreciation, and amortization, and then its margin. Now, the point about the adjusted EBITDA is that they defined away 12 separate parts of their expenditures in order to make this happen on paper. In other words, this is a chart crime, folks. Whenever you see something like this, when a company gives you what are called non-GAAP measures and say that that proves that we're heading in the right direction, you can be sure that you're being hoodwinked. Now, let's have a look at Uber's stock price before we proceed, because I just want to show you what has happened since their quarterly report earlier this year. This is Uber going back more or less to its launch. And look where we are. We're almost exactly at the high point. And when it got to that price level, which is around $47.50 a share, at that point exactly, that's when the market sold Uber off. Because the market doesn't want this company's share price to be any higher. It doesn't want it to be where it was earlier this year, when all the stocks in the world, in fact, got overpriced. A lot of us who invested in stocks during the first quarter of this year are still struggling to recoup the losses because, quite frankly, the market became insanely overvalued and Uber went along with it. But in the long term, Uber has hit resistance, and I believe it only has downward to go from here. Now, here's a chart that shows the consensus. This is from Seeking Alpha, and it shows right now the rankings. And this goes across, this is basically the rankings from Wall Street and Seeking Alpha's writers and a few others. But it shows that right now, Uber scores at the very bottom of pretty much any metric you got, except for growth. What is growth, though? Growth is the growth of revenue. And if you can't grow your revenue faster than your costs, you'll never get out of the red zone when it comes to profitability, or revisions for that matter. So here's a chart that shows Uber's performance between 2015 and 2020. Now, this is not the whole time that the company has existed, but this is during its public existence. It's made money every year, and for a lot of time that revenue has been growing. So yes, there is growth, but look at the profit. Profits, in fact, the smallest loss Uber ever had was in 2018 on profits of 11.3 billion. But look at the last 2 years up to this year. I mean, that's just not sustainable. If you can't, if you got that kind of user base, look in the right-hand column, you're growing your users, you're growing your revenue, but you are losing money at an increasing rate or just at an acceptably high rate, then you haven't got a business model, right? Now, just to prove that we're in a very similar sort of scenario, here's a chart of Lyft, which I'll come back to in a moment, showing that they also have hit long-term resistance levels. They may be able to get back up to that kind of $65 a share level, but that's about the best you're going to get. And I think it's also headed for a long-term collapse. Here, for example, is a chart that shows, or a graph that shows the same thing I just showed you with Uber. This is their valuation, profitability, etc. So doing very well in terms of growth, but their valuation is just out, compared to the money that they're losing, they're just not able to, impress anybody with their stock price, because you can't pay for stocks for companies that never make a profit. And I think the market is starting to look at this. Now, here's Lyft's net generally accounted or accepted accounting practice losses. This is when you take away the smoke and mirrors of adjusted EBITDA. You can see that the company's cumulative losses just keep growing. They've managed to bring their net losses down, but there's still, billions and billions of dollars. Now, why is this the case? Why am I so bearish on these companies? A lot of my colleagues aren't. A lot of them, say I'm just not a visionary. Well, because I'm an economist and I know about something called unit economics. Now, unit economics is basically whether you make more money on each of your product that you sell, whether it's a service or a product, a physical product, than you spend to deliver it. And if you can't do that, you don't have a business model. And that's why you need people like the Saudi royal family to pump money into your business, so you can try to get to a monopoly position where you can charge more money than people were paying before for other services, like taxis, yellow taxis, and then make a profit that way. That has been these companies' business model ever since the very beginning. Problem is that the taxi industry that Uber was trying to disrupt has never been profitable when it's been unregulated, ever, ever, ever. When the taxi industry launched, the automotive taxi industry began to replace horses back in 1907 in New York. One of the first things that happened was that people would come into the city. In other words, you didn't have to have a permit. You just had to hang a shingle on your Ford Model A and say, I'm open for rides. So many people did that it led to a situation where nobody could make any money. And that led to violence, actually, just as it led to violence when Uber has launched in pretty much any city of the world. Because what happens is that the existing players say, hang on a minute, if you come in and compete with us and try to undercut us with your subsidized rides, then you're putting us out of business, and then we'll never have any option except to work for you. That's what Uber wanted in the first place. Now, what happened in New York in the 1930s was that eventually the process or the violence got so bad that the city government said, well, we're going to have to regulate this. That's when they instituted taxi medallions. Taxi medallions are a way of regulating the number of taxis that you allow, and they do it to make sure that the business is both financially sustainable and that it doesn't result in social chaos. Now, people like Uber have always said that their job is to disrupt this and to get around it and deliver their products cheaper than anybody else. But what they're actually trying to do is to drive everybody else out of business. So they're the only player in town, so they can then raise their prices to the point where, essentially they are making things more expensive than the taxis used to be, all because they've essentially, without regulation, they've used their subsidies to destroy all competition. In fact, that's exactly what happened in Washington, D.C. not too long ago when Uber came on board around in 2007. It wiped out all the taxis. Now, Washingtonians are paying more for Uber Lyft or rides than they were paying for taxis back in 2007. That's exactly what Uber was aiming for. The problem is that Uber's business model cannot change the basic fact that if you have an unregulated market, anybody can compete with you. So it doesn't matter whether or not there's one other competitor like Lyft or whether you've got several of them like you're seeing in places like New York, where you've got many of these players coming in. As long as there's an option, consumers will go to the lowest priced one. And that prevents a company like Uber ever making a profit. So their only business model is to become a monopoly. So if they were a monopoly, they could raise their prices, which, then they wouldn't have to worry about undercutting, but they can't do that. So what happens? You get everybody coming in, they start undercutting Uber, and that means that the drivers are not making enough money. Uber's option is to either raise their prices or cut the driver's share, which in case either the customers would stop using Uber or the drivers would stop driving for them. So the bottom line is that Uber does not have a viable unit economics-based business model. Neither does Lyft, neither does DoorDash. So what happened? Just yesterday, Uber was forced to raise their prices by 10% in London. Eventually, they're going to get to the point where those black taxis are just as usable as Uber. You can hire them on an app as well. And so Uber will just have no leg to stand on. Now let's compare Uber to a company. Let's use Lyft as the example. But let's look at what would happen if this business model were applied to software, like software as a service, i.e. SaaS. Now here we have in orange, we have the actual contribution to profit coming from the Lyft's operations based on their actual results. Now, let's assume that you have a software company where most of the expenses are the development of the product up front, and going forward, your fixed or your variable costs, in other words, your everyday running expenses and those kind of things, are relatively limited. Now, the blue line is Lyft's actual revenue. As you can see, if you're a software company trying to run a platform program like Facebook or Google or somebody else, you will be profitable using this networking flywheel type model. But in the real world, where you have to fight, other competitors, and where you have to pay drivers, and you have to attract users and all that sort of stuff, you don't have that luxury. What happens essentially is that your variable cost, the cost of providing each ride or delivery, goes up just as fast as your actual revenues, which means that you never, ever make money. Now let's look at the restaurant sector, DoorDash, for example. Now, the problem with DoorDash is that the average profit margin for most restaurants is between 3 to 5%. That's about it. Can maybe be 9% if you're a McDonald's fast food restaurant, because everything's standardized. So the fees that DoorDash tries to charge for these people is significant, and it's got to be passed through to customers. And that means higher menu prices, and eventually people will say, no, I don't want that. So for example, Chipotle has 17% higher prices for any food product that you buy through one of these delivery apps like DoorDash or Uber Eats than if you come in and buy it yourself. So if these companies keep raising fees, eventually customers are going to go, look at this. I'm actually not going to go, I'm going to go buy the food myself. In fact, I did that last night. I went to a local burger joint and picked the stuff up because it was so much cheaper than ordering it. Now, here's just, for example, the 2019 figures for DoorDash. You can see that they made quite a bit of money, but look at the pass-through payments. That's the money that they have to pay to the restaurants. Then there's, of course, some refunds and credits and promotions, but their revenue is just extremely low. It's only 11% of their total, and that cannot cover their operating overhead costs. Remember, this is a company that has a platform to manage. It has an app it has to develop. It has to do all kinds of things. So that $885 million got completely soaked up by running this big business. On the other hand, if you just had local people maybe on their own delivering for local restaurants without that overhead, they could actually make some money. And they do. They compete. So here's DoorDash's stock price. Since their launch, you can see that they hit a high recently after their own quarterly results were announced. But I just can't see it going any higher than this, folks, because it's not a viable business model. Now, a lot of people will say, well, you're just, you're not visionary enough. You don't see the potential for disruption. Problem is that disruption is not something that you just do without any kind of reaction. So what about regulatory threats? For example, rideshare companies like Uber and Lyft have had a severely negative impact on road congestion, carbon emissions, and overall transport effectiveness in almost any city where they operate. You end up with so many Uber drivers trying to compete for business, all at subsidized rates, that the roads are more crowded, takes longer to get from A to B, you're ending up congesting the cities, they're parking in bikes lanes, all these kind of things. So that's the one thing. No city on this planet is going to ignore that, and nor should they. Second thing is, they say, well, we'll have autonomous vehicles. Well, even Uber has given up on that. They, through a little bit of a deceptive sleight of hand, they sold their autonomous vehicle unit to a third party, but the problem was that the third party turned out to have been created pretty much by Uber, and Uber lent them the money to do the transaction. They just wanted it off their books because they knew it was never going to work. So folks, the bottom line here is that the whole notion of platform economies and flywheels is great if you are a technology company, a real technology company. Not so great if you operate in the real world, where unit economics mean that your cost of sales go up as rapidly as your sales, if not faster. Bottom line for me is that these companies have always been about what they call the bezzle. The bezzle is that magic interval where a confidence trickster knows that he has the money and the victim doesn't yet know that they've lost it. So my advice to you is stay away from these companies with a 10-foot pole and look more closely at where real value is being added in a way that actually contributes to margin growth and profits over time. And right now, my two favorites are renewable energy and the semiconductor sector, and of course, a third favorite, software as a service, which I believe if you get the right companies, and we have some triple-digit winners in the Bauman Letter, you're going to make a killing. This is Ted Bauman signing off. Talk to you again next week. Bye-bye.